Is credit repair a scam? Here's what you need to know. Let's begin.
This is Debt Free in 30. Here's your host, Doug Hoyes.
Ted, welcome back. You have no cue cards today. You do not know the topic because you just walked over from your office 30 seconds ago. That's the way I like it.
And these are the ones, that's the way the people like it, right?
The way the people like it. That's right. Then we get your unfiltered opinion. So, well, I guess you know the topic because you heard the teaser there.
Right.
In the olden days, which is 5 years ago, that's how I define the olden days. When you and I were still young, we'd meet with our clients and they'd be worried that because of all the debt they have, they might not be able to buy a house someday.
Right.
So to confirm the amount of debt they had, we get them to get a credit report from either Equifax or TransUnion or both. And it wasn't easy because you had to mail away for it and it took 2 weeks. It was a big hassle. Now, today, in the modern era, almost everyone I talk to has the app on their phone.
Right.
And they know exactly who they owe money to and they know their credit score. And if they don't have one of those free apps on their phone, it's not a big deal. You create an account, a free account with Equifax or TransUnion.
And most of the banks have got access to it somehow now.
Exactly. Through your bank account, you go in, click the credit report, boom. So it's very easy now to get your credit report online for free in minutes. So my first question for you, would you agree that every single Canadian in the history of the world who is alive today is obsessed with their credit score?
Well, my teenagers aren't yet, so I will not agree with that statement.
So there you go.
But the marketing people have done a good job of getting people concerned about these credit scores, and we don't even really use credit scores in Canada, not the same way they use them in the U.S.
So why are people obsessed with them then?
Well, because all of the marketing and advertising and everything else, a credit score is conceptually easy to understand. So whether you have good credit or bad credit, it's much easier on a scale of 1 to 900. Well, my score is 850. My score is 600. I'm pretty sure the guy with 850 has a better credit score than 600.
That's a very interesting. See, this is why I like not giving you notes, because you come up with these brilliant insights. It's like when I go to the doctor and I say, hey, am I healthy? Right. The doctor does not give me a score.
No.
Because, and I haven't been to a doctor in 20 years, so maybe they actually do this now, but
they don't.
There's many different facets to it, right?
Right.
Well, what's your cardio? What's your this? What's your, like, there's a whole bunch of different
things. You're packing on some extra weight. You're better than me these days.
Well, I wear dark.
That's what it is.
See, you're wearing light, so you got to wear dark with stripes, and then it all works out. But you're right. With the credit score, it's very easy. It's distilled down to a 3-digit number, and you can tell. Now, I also agree with your point that it's kind of nonsense,
right?
Because every lender has their own system.
Well, that's the part that's really crazy. So in the U.S., you've got FICO scores and Beacon scores. And in Canada, we've got whatever score they want to give you. I mean, my dad used to have a sign on his office wall that says, the statistician will tell you all sorts of interesting facts, but it's all based on whatever the village watchkeeper writes down, and he doesn't give a damn.
Your dad being a professor, so just so we all know.
As opposed to a watchmaker.
Exactly. Yeah, and you're right. If I'm a lender, okay, I'm going to look at your credit report, obviously, but I'm going to look at other factors as well. Right. One of the factors might be, so have we met our quota this month?
Right. How desperately do I need to issue this new credit? And what's the marketplace like? So that can make a much larger difference than people realize.
Right. And if I'm getting a car loan and the lender makes money on car loans and we need to sell some cars and there's a deal between the manufacturer and the lender, then that's going to affect it as well. So now, and this isn't the point of this show, but just so everyone is aware.
You didn't give me cards. The point could be whatever I want it to be.
It could be. So your credit score is based on a number of factors. We're going to talk about utilization in a minute. It's based on history and level of debt and a whole bunch of things. So the formula is just taking all those factors and making it a number.
The only way I think credit scores are actually useful is as a trend indicator. So I know whatever this lender's credit score for me today is because it's on my app. And I look 2 weeks from now, has it gone up or has it gone down? So it's gone down, something bad has happened. It's gone up, something good has happened.
Or the data's all messed up.
Or the data's all mixed up because we're back to dealing with the watchmacher.
Exactly. Now, I do agree with you. If your credit score takes a big hit and nothing has happened, well, has my identity been compromised?
Right. What the hell is going on?
What's going on? So yes, I agree. That's a good indicator. Now, You remember many years ago when I wrote this wonderful book, I don't know if we can get a shot of that or not, Straight Talk on Your Money, The Biggest Financial Myths and Mistakes and How to Avoid Them by Doug Hoyes, still available on Amazon. People buy the Kindle version now. You can also listen to me read it. On page 48, you remember page 48.
Of course, as if it was yesterday.
As if it was yesterday, I discussed the credit score scam. And I said that a credit score is a measure of your ability to handle debt. So you need to have access to debt to have a credit score. So is credit repair as simple as getting as many credit cards as possible to increase your score?
Well, that's an interesting perspective. That'll actually decrease your score.
Right, because like we just said, there's many different factors. One of them is how much debt do you have?
Or how much access to debt do you have?
How much access debt do you have? So you could have 10 credit cards with a $10,000 limit on each. That's $100,000 of access.
Right.
If I'm not using any of it.
So your utilization rate is really low.
So explain utilization rate.
Well, so you've got that $100,000 we just talked about, 10 credit cards at $10,000, but you're only carrying a balance of $1,000 in total. So your utilization rate is 1%.
And in general, the lower the utilization, the better.
Yeah, there's a caveat to that that means that you haven't currently borrowed the money. The downside is, though, that you still have access to the money. So it's still a double-edged sword.
Okay.
Right?
So now we're getting into the interesting thing. And first of all, let us, in the interest of full disclosure, tell everyone we have no idea how the credit score calculation is made.
Well,
they do not show us the algorithm.
It's different for every lender, for every reporting agency. And I mean, the ones that drive me crazy are the guys that make you pay a monthly fee for this stuff. There's still a couple of companies doing that.
Yes. And what we are advocates of is either don't pay attention to it, and we'll talk about that at the end, or get the free version. Now, I understand if you get the free version from Equifax or TransUnion, you don't get your credit score.
They don't give you scores.
Because they want you to pay for that. But it tells you, here's who I owe money to. Do I have any late payments, any judgments, any creditor action, collection action, whatever? Isn't that pretty much what you need to know?
Right.
And so getting lost in the weeds of all the rest of it is kind of nonsense. The reason they don't publish the exact formula is because we would game it.
Right.
So if we knew that the perfect utilization rate was 12.2%,
then you would make sure you had access to enough credit, regardless what your debt level was, that it worked out to 12.2%.
Right. And in order to have a 12.2% utilization, that means there is a balance owing on somewhere.
Yes.
Which means I'm paying interest.
Mm-hmm.
Okay, that's not good.
Doesn't make any sense either.
So as a borrower, I want my utilization to be zero.
Mm-hmm.
Because that way I'm paying no interest.
Right.
So, which is, and again, what was the title of this show? What Canadians Need to Know About Credit Repair. Okay, so let's start thinking about this practically then.
Okay.
Well, actually, let's hit a couple of these questions, then we'll go into the practical stuff. So this is kind of the same question. Can you have too many credit cards?
Definitely.
How do you think about that then?
Well, so in my opinion, you should have at most two. One for day-to-day use, and then if you need one for tax purposes or work, a second one so you can keep them separate for record keeping. But
I want to have 12 of them because each of them have different rewards, you see. This one is good if I go to a restaurant. This one's good if I buy gas. So shouldn't I have as many as possible to play the reward game?
Well, if the reward game is more important to you or the most important consideration, then I guess I'd have to say yes. I'm going to tell you that it probably shouldn't be the most important consideration. So again, we're talking now about credit scores and repairing credit that's been damaged. The more different credit vehicles you have, the more risk you have of running into trouble.
That's the key right there.
Right.
If I've got 10 credit cards and something, well, I'd really like to buy that thing over there. Hey, I've got this credit card.
You've got these 10 credit cards and something goes wrong. And most of us don't have savings anymore because we've got access to credit if something goes wrong. Well, once you accumulate $100,000 worth of debt, those $10,000 credit cards, you're going to have a hell of a time getting out from under it.
But you're right. I don't have savings. One reason is it's so expensive to live and inflation's high and all the rest of it.
And you earn nothing on your savings.
Right. And that's the other thing. I earn nothing on my savings. So, okay, I realize interest rates are marginally higher than they were a couple of years ago. But if I've saved up $1,000 and I put it in a savings account, I'm earning essentially zero.
Right.
So why would I do that?
What's the incentive?
What's the incentive? Would it not be better to have a third credit card as my emergency fund so that if something goes wrong, I've got it? What's wrong with that strategy?
I at some point, did you work for a bank?
No. But we're looking for sponsors. Right. This is season number 11, and we still have no sponsors. So if some big, huge bank wants to throw a lot of money at us, but that's the way a lot of people think. Like I get 0% on my savings. So why not, instead of, building up savings, why not have a credit card that I don't use, it's tucked away, but if I have an emergency, if I get a flat tire, my car breaks down, I'm off work for 2 weeks, like something, and I need instant access to money, what's the problem with that?
Well, there's no real problem with that as long as you've got a plan on how to deal with that credit card, that debt balance after the fact. So you got no savings, you got to have a new transmission in your minivan, okay, $7,000, you got it fixed. What's the strategy now to pay back that $7,000?
And so your preference would be that I have $7,000 saved up in case I need a new transmission.
No, I'm equally happy if you've got a plan for where the $7,000 is going to come from. The issue is, most people, the plan is, I've got this credit card for emergencies. And that's the extent of the plan. And that's kind of, you're missing something there.
So if I was able to save some money, put it in a TFSA, something like that, then at least I've got that backstop there.
Right.
The risk with having too many credit cards is you use them.
That's right. So if you've got one credit card with a $10,000 limit, then $10,000 is as deep in the hole as you can get. If you have 10 credit cards with $10,000 limits, it's $100,000. I'm telling you, there's no way, based on the average Canadian's income, you can pay back that $100,000.
And that's the problem. So let's say I've got a bunch of debt and I'm trying to, repair my credit score here. That's the whole point of the show. Is it possible to have debt removed from my credit card? Is there some secret number I can phone to just make it go away?
Not that I am aware of.
So, but there's all these places that say they can do all this stuff.
And they charge a reasonable fee.
Yeah. And you're right. That's pretty much a scam. The credit reporting agencies, Equifax and TransUnion, they take the data from the banks, all the different lenders, and they put it on your credit report.
Yeah.
And the only way you can get something removed is if it's on there erroneously.
Right. And there are systems to do that.
You can prove it. Yep. And you're right. You can. Then that's one of the other reasons for having an account with TransUnion and Equifax. There is a dispute resolution process built right in.
Right.
And it's actually much easier now than it was a few years ago, because when you look at your list of creditors, here's, Joe's bank or whatever, you can actually click on it
and say, wait a minute.
Here's the reason this is not a legitimate debt. But if it is a legitimate debt.
Yeah. I mean, your credit report is based on the history of how you use credit, how you use debt. So the best way to repair it took time to get bad. It takes time to get better. Yeah.
And we're going to go into the practical stuff now
later.
After this. One more question. And that is, how often should you check your credit report? Should it be every 5 minutes?
Yeah, so it depends on your personality type. The folks that obsess about this are really doing themselves a disservice, because you're just creating stress where it doesn't need to be there. If you've got the free app, then I certainly think you should look at it a couple times a year and do it on a regular basis. So I'm going to do it on my birthday. I'm going to do it at Christmas. I'm going to do it at New Year's. Some kind of schedule so you remember to do it. But if you're the kind of person that's going to look at it daily or hourly, you're really not doing yourself any favors.
Yeah. And I would say you want to look at it before you are going to be making a major borrowing decision. I'm financing a car, I'm getting a house, whatever. Okay, well, then you want to make sure there's no errors on it.
A major borrowing decision also includes a big purchase on an existing credit card or line of credit, right? It's not just I'm applying for new credit. I'm going to incur some new debt now. What's the world look like?
Right. So I should be aware of that. But I agree. And again, back to our health analogies, should you weigh yourself on a scale 5 times a day? No, that's just kind of stupid. So, okay.
You're going to be very unhappy.
Yes. Well, and it fluctuates. So you're not getting any reasonable data anyways. So with the credit score, and I know with at least a couple of different banks, you said you can get your information directly from them.
Yep.
They've actually got the history too. Mm-hmm. It'll show, oh, your credit score was this. Okay, well, I don't need to look at it every day. I can look at it, like you say, every few months. Has the trend changed? And don't worry too much about it. Okay, so now let's do the practical advice here. So again, the title of today's show, What Canadians Need to Know About Credit Repair. So, okay, how do I repair my credit? So I've got a list here of 4 things. And I'm going to tell you what those 4 things are, and you're going to tell me whether you agree or not. The first thing on my list is reduce your debt.
Okay. And that makes sense because your credit report is really talking about how you use and repay debt. They call it credit report because that sounds better, but it really should be your debt report.
Debt report, I agree.
And if it was called the debt report, nobody would look at it because nobody likes that word.
Because they call it life insurance, not death insurance.
That's
Same
right.
reason.
It's got negative connotations.
Right.
How's that for a word?
That's a very good word. And they also call it a credit card, not a debt card.
Correct.
For the same reason.
Yep.
So I think I talked about that in my book too. So, okay, I want to reduce my debt. The obvious first step, well, do I have any assets that I could sell? Most people who have a lot of debt don't have a lot of assets, but what would be a common asset or two that, okay, well, maybe I don't need that, I can liquidate it?
Well, so now that everybody or a good portion of the population is working virtually, maybe the family doesn't need 2 cars anymore. Maybe it can make sense to only have one and use Ubers when you need the second one, or Lyft, or whatever those services are called.
Right. And maybe you don't need any cars. You live,
right.
Transit, whatever. So, okay, cars. What about cashing in your RSP to pay off debt?
Yeah, that's a bad idea. RSPs were created because they're trying to force you to save for tomorrow. So if you've got money accumulated for your retirement, for those golden years, which you and I are getting close to. We're
already there, man. Already there.
You don't want to be taking the money out of those things unless you absolutely have to.
And there's a tax implication to taking it out.
And you can't put it back.
So with the TFSA, you can put it back and there are no tax implications, which is why if you're using something as an emergency saving fund, a TFSA probably makes a lot more sense.
Right.
Now, I understand I've been laid off for 6 months. I got to pay the rent. Okay, well, then you're going to tap into your RSP.
Right.
But again, you got to understand that there's implications to doing that. The other thing, I guess, to reduce your debt is get your budget better, either increasing your income or reducing your expenses, but that's easier said than done.
Yeah, increasing your income either means you got to ask your boss for a job or get a second job or switch careers entirely, something new. And decreasing your expenses, it's hard to do overnight. So you can decide, okay, I'm not going to buy Pop-Tarts anymore. I'm going to actually have a proper breakfast instead of grabbing something quickly. That'll save you a few bucks every week. And that will add up over time. But you can't get out of necessarily your mortgage or your lease. You can't do anything about your car payments really quickly. You got to pay insurance. There are things that you have to pay for that you can't just reduce overnight. Yeah,
which is why all the gurus say, well, you got to give up your latte.
Right.
Whatever that is. Have you ever had a latte?
I don't drink coffee. Can you imagine me on caffeine?
No, I cannot. I don't think I've ever had a latte either. I drink lots of coffee, though.
Right.
So, and of course, the thing that you and I do at Hoyes Michalos to reduce your debt is a consumer proposal. So give the 30-second explanation of what a consumer proposal is.
So a consumer proposal is a legal procedure whereby you offer to repay a portion of what you owe. Now, the first response anybody ever makes is, well, why would anyone accept a portion of what you owe them? Well, because the alternative is often an assignment in bankruptcy. Bankruptcy, you're saying, I can't pay my bills. And the proposal, you're saying, I can pay some of my bills. And then it's a negotiated settlement.
And that's a way to reduce your debt. Now, obviously, that is not the first step. We're going to, talk about, we already talked about it, selling assets, increasing your income, reducing your expenses, whatever. But if you have an overwhelming amount of debt and there's no way I can possibly pay it back, I can't just wait for them to start garnishing my wages, the consumer proposal becomes an obvious answer.
Right.
And obviously, you got to sit down with a licensed insolvency trustee, such as you or me, to explain all the pros and cons of that. And obviously, maybe it's not obvious, but if you file a consumer proposal, it gets reported on your credit report.
It does.
And so if you have perfect credit now and you got an 800 credit score, which some people do when they file a proposal.
They do.
It will make your credit score go down.
It will.
So it is something you do when, okay, I'm going to take a temporary hit on my credit score, but I reduce the debt and therefore I can live to fight another day.
Well, and there's lots of benefits to this other than the fact that you're going to pay back less than 100% what you owe. You're likely not paying any kind of interest component anymore. And it restricts your ability to incur new debt. So it forces you, when maybe you haven't had the discipline in the past, to look at debt and credit in a different way.
That's going to be the new number 2 on my list here, even though I didn't have it in the script, which is...
Change your credit paradigm?
Yes, exactly. Change your credit paradigm, which I guess in paradigm.
Yes, I know.
I don't even know how to say the word. I guess the way to do that would be, well, I'm going to cut up my credit card.
Yeah. I'm going to put them in an ice cube tray or something.
Yeah.
I've seen that too.
That way you can't use it immediately. Of course, it's all the code's in your phone. You can buy stuff, whatever.
You got a microwave, right?
Yeah, I do. That's not where you want to put it. Ours has making this humming sound recently, but if you've got 5 credit cards and we follow Ted's advice and say, well, I really need at most 2, one for personal, one for business expense, or maybe one as a backup in case the bank is down or whatever. Well, I guess I could contact the bank of number 3, 4, and 5 and say, you know what? I don't need it anymore. I'm canceling it. So
and you'll take a hit on your credit score when you do that.
Will, yes, because now your authorized credit has gone down.
Right.
So, but it also means you can't get into any further debt. So that's changing your paradigm there.
Right.
Okay. So number 3, save money.
Right.
Now this is something that is not reflected in your credit report, what you call the debt report.
Right.
Because it's not debt.
Yep. And
So
there's no way for them to put it anywhere.
yeah, it's not a thing. But I'm a big believer that, okay, you should save money for a couple of reasons. Number one, if you have cash, you need less credit.
Right.
And cash can be used as a down payment on a loan, so it becomes necessary. So if you're financing a car, well, they're going to ask you to put down something most of the time.
Yep.
$1,000, $2,000, $5,000, whatever.
Or you're going to pay extra.
Or you're paying way more. If you're buying a house, well, you have to have a down payment.
That's right.
CMHC does not insure 100% mortgages. So even though saving money does not improve your credit score, I still think it's a very necessary step. Do you agree?
Yeah, well, it doesn't improve the score directly, but it has a positive influence on what your score may be in the future. Because you can use those savings, as you say, as down payments to reduce the amount you borrow for a car, the down payment on the mortgage. It allows you to be more flexible if something does go wrong. You don't have to tap into your emergency credit card.
Right. And if I need a new pair of boots and I've got the cash, I buy the new pair of boots. I don't put it on my credit card, so I don't have to pay any interest or anything like that.
Well, let's roll all the way back, though, to your rewards thing, too. It's okay to put it on your credit card and then use the cash at the end of the month to pay it off. What you can't do is put it on the credit card and spend the cash. That's the problem.
Yeah, and so if you want to play the rewards game, okay, fine.
Right.
But you're right. You already said it. You got to have a plan to pay it off. So if the cash is sitting there in my bank account, okay, fine. I'm using my credit card as a substitute for cash, not a way to borrow.
Right.
It's all good. Okay, now, number 3, and this is something that a lot of people don't quite clue into, and that is, you got to pay all your bills on time. Now, okay, everyone understands that.
Right.
But something like your cell phone bill, which, okay, it's $100 a month. It's not your biggest expense. It's due on the 23rd of every month. If you routinely pay it a few days late,
you're going to take a hit.
Because that's going to get reported to the credit bureau.
Right.
And it's going to show that you're routinely late. And being late on a $100 payment is actually pretty damaging.
Right.
Because it's only $100. You might think, well, it's only $100. I've got $100,000 of authorized credit on my 10 credit cards.
Yep.
How can a $100 missed payment cause any grief?
Because you're paying late.
And it's such a small amount that if you can't pay that,
right,
the algorithm goes, whoa, this is really bad. So my advice for things like your cell phone bill, hydro, gas, whatever, any bill that is paid on a monthly basis, either set it up for direct, suck it out of my account.
Yep, automate it.
Automate it. I knew there was a better word than suck it out of my account. Or, and some people don't like that, because what if the hydro company makes a mistake and sucks out 1,000 instead of 100? And then it takes me 3 months to get it reversed. The other option is you set it up auto payment yourself on your payday.
Right.
And that's my preferred option, particularly if you get paid every week or every 2 weeks. Every 2 weeks, I take my hydro bill, divide it by 2. Every payday, I know it's coming out.
We're generally big proponents of the whole time your bill payment with your income.
Absolutely.
So if you're getting paid every 2 weeks, middle of the month, end of the month, that's when you pay your bills.
Same with your car loan, your mortgage, whatever. Because I know when my payday is.
Right.
It goes in, it goes out. So at the end of the day on payday, most of my bills have been paid.
Right.
I don't have much money in my bank account, but all my bills are paid. I've just got to have enough for groceries and, gas, bus fare, whatever, till my next payday. So paying all your bills on time is critical for not only repairing any bad credit you've got, but keeping it good.
And it's just indicative of your attitude, too. If you're willing to miss little payments like that, what the hell's going to happen with bigger payments?
Mm-hmm. And I think the computer algorithm captures that, and that's why it's very damaging. So they may seem like irrelevant things, but they're actually important. Okay, now here's the final point on my how to repair your credit list. And this is something that I learned from Richard Moxley, who's been on the show many times. I'll put links in the show notes. So those of you who are watching on YouTube, you can just go to the bottom or any other audio platform. This is where I should put the commercial to click the buttons and everything too,
there you
right?
go. Yeah.
So click all the buttons, people, notifications and subscribe and everything else. So he has what he calls the 2-2-3 rule. Maybe he calls it the 2-3-2 rule. I don't know. But so here's what he says. 2-2-3. So if, let's say, you have a bad credit event and your credit goes bad, maybe you filed a consumer proposal, you want to be 2 years clear of that event. That's when your credit will, really start to take off to the upside. Now, a consumer proposal appears on your credit report for 6 years from when you file it,
right?
As does pretty much everything else.
Correct. That's why it does that.
Yeah, exactly. That's where it came from. So things purge after 6 years, but it's 2 years after the default that things start to certainly improve. And in fact, CMHC, if you're buying a house, has a very specific rule that says we will not guarantee a mortgage for someone who was in a consumer proposal until they've been out of the consumer proposal for 2 years.
Okay.
So now CMHC only matters if you have less than a 20% down payment. If you got a 30% down payment, it doesn't matter.
And you're not using Genworth or all those other people.
Right. But that is their specific. And we actually had a guy a few years ago who was like 3 days short of the rule. And so they wouldn't give him the mortgage. Well, he waited 3 days and then it was approved.
Right.
The commuter did. So that's the first thing. Life, you already said things happen slowly. Well, it's the same on the other end. You got into debt over a period of time. It takes a period of time to get out.
Right.
The second two is 2 new trade lines. So, and everybody here at Hoyes and Michalos advises people the same. If what you want to do is improve your credit score after your proposal is done, then you're going to want to establish 2 new trade lines,
right?
Which is a fancy word that means what?
2 new credit cards, 2 new sources of credit debt, whatever you want to call it.
Credit cards would be the most obvious example.
Right.
So, okay, my proposal ends. And so I let's say I have no credit whatsoever. Everything's been stopped as a result of the proposal. Now my proposal's done. So what do I do? Well, and again, when you meet with us in person, we'll tell you more specifics, but there are certain credit cards that are easier to get than others, let us say. And so we would say, okay, that's the place I would go.
Just try getting my wife's credit card.
There you go.
Never
happened. So, there is a retail store that, used to sell tires in Canada. I'm not going to tell you who it is. They sell other things now. But when you walk into that store, there are 4 guys in, golf shirts trying to sell you a credit card.
Right.
That one tends to be easier to get than some of theirs. Okay, you go to the store. Yep, okay, sign up. Now, maybe you're only going to get a $500 limit because you're just out of a proposal.
But you got to start somewhere.
That's your first trade line. You wait a few months and then you go to one of the other places that are also relatively easy to get. And they go, well, we see that you're in a proposal, but we see you already got 1 new card. Fine, here you go. Here's a $1,000 limit. You wait, a few more months, go back to the first one and say, hey guys, can you bump my limit to $3,000? Okay. Now, of course, in this whole discussion, I'm assuming that every month you are paying your card in full.
That you are using it and paying it in full. So just having the card isn't enough. You got to establish a history.
Use it, pay it. Use it, pay it.
Right.
And, pay it every week. That way you never get into any trouble. And of course, you've got such a small credit limit, it's not like you can rack it up a whole lot. So then you go back to the second one after a few months, get them to bump it up. So you end up with 2 years after your proposal's done, 2 new trade lines, credit cards, whatever, with an authorized limit of $3,000 on each. If you do all of those things, almost for sure, your credit score will be 700 or higher.
Yeah, it's going to look good.
It's going to look good. So it doesn't happen instantly, but that's basically the formula. And I would say if you are someone new to Canada, maybe you're a recent university graduate, just getting yourself established, that's kind of the formula. Takes a bit of time, 2 trade lines, $3,000 on each, and you'll probably have a pretty good credit score.
There you go.
That's it. That's basically the whole pitch. You don't need to be paying one of these credit repair companies thousands of dollars to do stuff.
Right.
And their big scam is, here, Ted, we're going to give you a $2,000 loan, a $5,000 loan.
Right.
We're not actually going to give you the money. We're going to put it over here in a term deposit. We're going to pay you 0.5% interest. You're going to pay it every month. We'll report to the credit bureau that it's a loan. We're also charging you a big fee, by the way.
Right.
And then at the end of it, once you've paid it, we'll give you the money back. Okay, well, I just paid a whole bunch of fees. If I had just done the 223 thing, I'd have been fine.
That's right.
That's our advice. Much simpler than that. Any final comments that you want to make on repairing credit, what you need to know?
No, I mean, the important thing is that it takes time for your credit to deteriorate. It takes time for your credit to reestablish itself.
Right. And it's mostly common sense. Don't spend any more than you have to. Have some savings. Everything will work out fine.
There you go.
There you go. See, wasn't that hard. So that is our show for today. As I said earlier, if you're watching on YouTube, you got to click the notification button. You got to click the subscribe button. And then if you watch YouTube on your phone, which I know you do, that's all you do. Is
What's
watch
YouTube?
YouTube. It's a video sharing service.
Gotcha.
You actually have to go into your settings and make sure that there's a notification that beeps every time we put up a new video. So do all that. If you're on the audio platforms, Spotify, Apple Podcasts, whatever, same deal. Subscribe. There is a new show that comes out every Saturday morning. We always look forward to that, don't we? So until next week, thanks for listening. I'm Doug Hoyes for Ted Michalos. That was Debt Free in 30.